Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Chinese shares slide, heading for their lowest close in more than 5 years. That's as bearish sentiment grips the market. But exports from China unexpectedly jump to a 2-year high. Apple reveals the latest version of its flagship iPhone, aiming to entice buyers with the promise of AI-powered tools. This as the company awaits an EU ruling on whether it owes a €13 billion tax bill. Plus, Trump versus Harris, the Republican and Democratic presidential contenders prepare to face off for the first time in a live debate. We discuss what to expect. Happy Tuesday. European markets looking for direction. Modest gains of around 0.8% for European stocks yesterday, making up for some of the downside that came through last week. You also saw gains of a little over 1% for the Nasdaq 100 and the S&P as well. Today, European futures pointing down by just 0.1%. The FTSE 100 also looking for direction, currently pointing to losses of 33 points. S&P futures lower by 0.2%, and Nasdaq futures off by 70 points, again after closing yesterday up 1.3%. Let's flip the board and look cross-asset. Treasuries relatively calm for now. 370 the last time I checked on the 10-year. There you go, 370 on the 10-year. We have the CPI print, of course, inflation data out of the US on Wednesday, so building up to that. The pound is at 130. Brent 71.74, just down 0.1% on oil. And gold holding above 2,500 currently per troy ounce, but just down 0.2% so far in the session. Let's cross over to Singapore right now. Avril Hong standing by for a check on the Asian markets. Avril.
Yeah, Tom, we're seeing a bit of a mixed performance in Asia equities. Some of them looking pretty range-bound, including on the Japanese and South Korean ones, ahead of the US CPI, as well as investors anticipate what we could potentially get from that Trump-Harris debate. But it is a bit of stabilization from the rout a day ago, where the focus really is in Chinese equities. As you mentioned a short while ago, we got an exports number for the month of August that beat. So this is a rare bright spot for the Chinese economy. But look at the imports number and what it's telling us about how weak domestic demand is. That's really cold comfort, especially taking it together with the CPI and the PPI numbers just a day ago, which show you the deflationary risk in China. So CSI 300, well in negative territory, about 0.33% off, I should say. But flip the board, because another thing to consider when we look at these Chinese stocks is also the geopolitical concerns in the mix. We have the likes of WuXi Biologics and AppTec. These are the Chinese biotech firms that are in the crosshairs of US lawmakers. And as we know, the US House has passed legislation targeting some of these firms. So among the concerns for Chinese equities, flip the board again, the primary concern for them is really what we're seeing in domestic demand or lack thereof. So if you look at the CSI 300 and you look at this gauge of mainland stocks, it's actually approaching the lowest close since early 2019. Two things I would highlight here. The concerns that, the stock market slump would erode business consumer confidence, cause a sort of deflationary feedback loop. This is ramping up the pressure for policymakers to act. The other element to consider here is, if you take the case of the Japanese experience, the longer they wait to push out stimulus, the more they potentially would have to come up with. So among the dynamics that we are keeping an eye on as we see this negative sentiment on Chinese stocks once again. Tom.
OK, we can't do too much on the Chinese stock story right now, so let's get more analysis. Avril Hong with a check on the Asian markets in Singapore. Thank you. Let's bring in Mark Cranfield right now from our Markets Live team, because the China story is top red, at least two of the stories today on the property sector and, of course, on the rout that we're seeing more broadly across these equity markets in China over a 5-year period. What does it take to turn things around, Mark?
They need a massive circuit breaker to try and change confidence in the Chinese market. Sentiment is so bad. And on that chart that Avery was just showing you, traders can see that every time there's a small rally, if they sell into it, they're soon rewarded with lower stock valuations. And that's been pretty much the story since the pandemic 4 years ago. And so you just keep on repeating that time after time. So traders, they've heard lots of things. They've seen lots of potential moves by the Chinese authorities, and yet none of them have been very conclusive. They don't seem to do the job in terms of getting the money into the economy quickly enough, getting it to the right sectors, especially the property sector. And they appear to have shot themselves in the foot again today. They've taken out a number of property companies who are in this Stock Connect, which is a visible sign of movement between Hong Kong and China, the flows of equities. They've taken out some of the names so that people can no longer see which transactions are taking place there. That is not something that's going to inspire confidence, particularly in foreign investors. All the time we're seeing these small things which remove transparency. Foreign investors especially, they can move their money wherever they want to. They want transparent markets. Look at the United States. It's the clearest one of all. People can read the data, they can read the nuances, they can decide whether to go in or out. It's getting more and more difficult to judge what is really going on with the Chinese economy, what's going on with the companies there. No wonder that money is only flowing one way. Until they really can do something about this, foreign investors especially will not be putting their money there.
Well, Mark, on the economy, are we seeing green shoots, at least when it comes to the export engine of China?
We may well be, but the timing is really poor from China's point of view. So within the breakdown of those export data, guess what? The balance, the surplus with the United States went up again. We have the debate tonight between Harris and Trump. Guess what's going to be front and center of the debate? It's going to be China. It's going to be the surplus between China and the United States. They're not going to like it. They're going to pick holes in it. It's going to be a hot topic. There's no way that China wins from that situation. So the timing is poor from that point of view. More importantly, probably for the rest of the world, is imports crashed again. They're almost zero. That's no good for Asia. That's no good for the rest of it. China is not importing enough to stir up its domestic economy. That's not good news for anybody at all. All in all, the numbers on the surface might look great. The details are awful. They send a bad message, and it's not going to help the Chinese equity market.
OK, stark stuff coming through from Mark Granfield on the rout that we've seen in Chinese equities. And we'll stay on the trade tensions now and how that folds into US politics. Mark, thank you from our M Live team, because Donald Trump and Kamala Harris, of course, as Mark was saying, are preparing for what might be the biggest night of their campaigns, their first televised debate. For more then, Bloomberg's EMEA news director Ros Matheson joins me. Ros, what will Kamala Harris be hoping to achieve in this debate?
Well, this is an important one for her because, of course, there's a lot of debate about how much debates matter. And we saw that maybe with Joe Biden and his presidential debate. That was very consequential. For her, it's a chance to reach those swing state voters because the polling is really, really tight. It's in the margin of error. And what we know those swing state voters care about is the economy. And there she's starting to set out her stall on policies, talking about what she would do around various taxes. We know what Donald Trump would do. He would just cut all the taxes, he says, for everybody, from the corporate side to individuals. And they're trying to really sort of show their stuff now on the economy. He'll point to his record when he was president. She needs to start to explain what she would do around economic policy and how she would differentiate potentially from Joe Biden. What's her own agenda on this? And so the chance in this debate is to really speak to those swing state voters and explain what she would do if she was president around the economy, because that's where the votes are at the moment. They're up for grabs.
OK, Ros, what do we expect? This is crucially important, clearly, for both contenders, and you pointed to the fact that these debates can really matter now, and we saw that, of course, with Biden versus Trump. Just briefly on what Trump may be hoping to achieve, given that for voters he is a better-known quantity.
Well, it's interesting because he's been trying to find the attack line on her. He's tried different ones that she's, very, very far left, essentially a communist. That's not necessarily landing. So what's going to be his attack line that does resonate? He's still trying to find that. Equally, he also needs to show that he's sprightly, he's with it. The questions now about age are on him. They've shifted from Joe Biden to Donald Trump. He needs to show that he's up to the job in this debate, that he's mentally quick, that he's nimble on his feet. And so suddenly the onus on the age side is going to come on him tonight.
OK, Ros Matheson, EMEA news director, on what to expect, the preview, the lead-up, of course, to that what could be a crucial debate, of course, between Harris and Trump later today. And, of course, we'll be covering all of that and the market reaction for you as well. Now to the tech story with a focus, of course, on Apple's big unveil, launching the latest versions of its flagship iPhone. The tech giant is betting it can entice consumers with modest hardware upgrades and promises of AI technology that won't be included in initial models. Let's get more details then with Bloomberg tech reporter Annabelle Drewlers. Annabelle, how did Apple's pitch to consumers and investors go?
Well, I think you just had some of the key details there, sort of modest upgrades and things that haven't really changed from one iteration to the next. I mean, the iPhone 16 largely resembles the iPhone 15, save a couple of different changes. There's new colours that have come through. There's going to be a customisable action button that's going to be available across all models that replaces the mute switch. There's a more powerful chip. There's a new camera control button as well. So these are just some of the changes that have come through. But yes, as I say, 15 to 16, not really any sort of difference. The big changes, of course, is more around the artificial intelligence side. And this is an iPhone that the company says was built from the ground up for AI, though those capabilities are only going to be rolled out from October in the US and then to other regions as well. Market reaction-wise, investor reaction-wise, of course, we don't know the consumer side yet, but those angles, we didn't really see too many changes to Apple's share price off the back. That's sort of normal, given so much was already signalled. Supplies in Asia today are looking fairly mixed so far, but analysts, a lot of those continue to be pretty positive on the stock because they're saying that, yes, the AI features, they do set the ground for consumers to buy into the AI story from Apple over the coming quarters.
OK, Annabelle Drewlers on the latest when it comes to the iPhone 16, the Apple launch, of course, their prospects around artificial intelligence, or Apple intelligence. Annabelle, thank you. The day ahead, things to think about as well to put on the docket. 7 a.m. UK time, so counting down to this, it's the jobs data picture out of the UK. Unlikely, really, to change the thinking amongst members of the MPC, the BOE, but nonetheless important in terms of the shaping and evolution of this labour market here in the UK. And then today, later, of course, we're going to get those tech rulings from Brussels with the focus on Apple again and that potential impact in terms of tax money for Apple. So that ruling coming later today. And 2 a.m. UK time, the big one on the political agenda, the US presidential debate. Of course, we will be covering all of that live for you. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Subscribers can go to DAYB Go. And of course, that debate is front and centre, as are changes around capital requirements for US banks. Coming up, Kamala Harris, Donald Trump pitching their plans then ahead of the debate. We talked about that. We'll also talk about the impact that those potential policies coming through from both contenders could have on global trade with the WTO's chief economist. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Kamala Harris and Donald Trump have been pitching their economic plans ahead of tonight's debate. The former president calling for a 100% tariff on countries who shun the dollar and a levy of 60% on Chinese imports. The Democratic candidate, meanwhile, pledging to raise the corporate tax rate from 21% to 28%. So what kind of impact could these policies have on global trade? And what is the state of global trade? Joining me now, very pleased to say, is Ralph Ossa, chief economist at the World Trade Organization, with a report out in the last 12 hours or so from the WTO detailing where we stand on global trade. Ralph, this report is a clarion call for more global trade, for more inclusive trade. Critics might say it's a little myopic on the political realities on the ground in a number of the countries right now. Would you push back on that?
Well, first of all, thank you very much for having me. Of course, we do think it's a very timely report because trade is actually a very powerful force for inclusiveness, and we have to make sure it also remains a powerful force for inclusiveness. And for this, we need open trade, of course, but we need more than open trade. We also need support of domestic policies and international cooperation. And this is exactly what we are working out in more detail in this report.
There's a lot to unpack here, including a critique of the efforts amongst some nations to reshore parts of the manufacturing sector, other parts of their economies. The reshoring effort comes under criticism in this report. There is, of course, a focus on policymakers around the need for jobs, but also on national security. And I don't see a lot when it comes to the question of national security. This is clearly an issue for those sitting in Brussels and in Washington.
No, absolutely. National security is, of course, a key issue. In this particular report, we're not focusing so much on it, but we have other work on it, not just on national security, but also on economic security. So let me maybe start with economic security, so resilience of supply chains, for example. And there, the evidence is quite clear. If you have a world that is increasingly risky, if you have a world with supply shocks, what you need is outside options. And outside options is exactly what you get from open and also multilateral trade. Of course, I can understand, tendencies for home shoring, reshoring, and so on. But if you look at, for example, what happened during the pandemic, yes, initially we had issues with supply chains, but then very quickly trade became part of the solution. And I think that is something that is important for us to embrace.
What lessons do you think we've learned from Germany's previous enmeshing, and the rest of Europe, frankly, with the Russian economy and the impact that was had then on the Eurozone as a result of Russia's conflict in Ukraine? Because for some, they may take the lesson that enmeshing yourself too closely with another nation that is not a complete ally comes with risks.
I mean, of course, being overly dependent on a particular country poses risks. I think that's very clear. But, the way to respond to this is to diversify the risk. And this is not by making everything yourself, but by having a broad and diversified, deep supply chains. And this is exactly actually what we also saw in the context of the war in Ukraine. Yes, it's true that, countries like Germany struggled. But if you look at Africa, for example, what happened? They were also exposed to this because they were relying on a lot of grain imports from the Ukraine and from Russia. And what we could see is that because of trade, they very quickly found alternative sources of supply from very diverse countries. And this is not what you would get in a fragmented world.
Ralph, former President Donald Trump has threatened tariffs of 100% on countries that look to de-dollarize, 60% tariffs on China, potentially a 10% tariff on all goods coming into the US. What would tariff levels of that level mean and do to global trade?
Look, I won't be able to comment on the policies of a particular member country, but what I can say is that we already see first signs of fragmentation in international trade. So if you look at bilateral trade between China and the United States, it's very clear it's growing 30% more slowly than trade between these two countries and third countries since the first wave of Trump tariffs. But also more broadly, one thing we did is we divided the world into two hypothetical blocks. Depending on who tends to vote with the United States and who tends to vote with China and the UN National Assembly. And there you also see that trade within these blocks is growing more quickly than trade between these hypothetical blocks. So we are slowly moving out. These are first signs of geoeconomic fragmentation. And this is something we are concerned about. So we've done some simulations where we show that in the worst case scenario, the real income losses of such fragmentation could be up to 5% of worldwide real income.
Ralph, is the EU, is Brussels wrong to impose tariffs on Chinese EVs? And if they are, what are the alternatives?
Look, I mean, this is for the dispute settlement system to decide. But what I can say is that we have trade defense instruments here at the WTO. So it's not that you can't do anything if you feel that your trading partners are subsidizing, if you feel that your trading partners are dumping, or even if there's just an import surge. I think the important thing for us is that it all happens within the context of the rules here, because if you think about it, the WTO is not so different from a central bank. It's not just about trade costs, but it's also about trade cost expectations. And to keep these expectations low, we also need to preserve the credibility of the system. And to get that, or to maintain that, we need to play. We need people to play, or countries to play by the rules.
When you think about generative AI and the focus there, is there a risk that generative AI exacerbates some of the gaps within the trading balance globally, given how much power is embedded in US corporations and to a lesser extent Chinese companies as well?
No, that's a very important question. And indeed, we see digital trade, particularly digitally delivered services, grow much faster than services trade and also goods trade. It's been growing at 8.1% per year since 2005. So these are things like accounting services, marketing services, and so on. Anything that you can get, via the internet. And we view this as an opportunity for some economies that are not so included yet in global trade. But then, as you say, there's also the risk of the digital divide. So it's really important to do something about it. And this is really, I would say, the main message of the report. You need open trade, but open trade and supportive trade rules are not enough. You also need domestic policies. For example, if you want to engage in digital trade, you need internet. And 1 in 2 people in Africa doesn't have internet yet.
OK, Ralph Ossa, chief economist at the World Trade Organization, on that report, out with a focus and a call for more trade and more inclusive trade in a challenging environment, given the political dynamics at play globally. Ralph, thank you. Coming up, revenue from Goldman Sachs and the trading unit at that business set to fall 10% on last year. We're going to bring you that story and a roundup of what else you need to know. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other stories making the news this Tuesday. French car maker or caretaker finance minister, I should say, Bruno Maire, not a car maker. Bruno Maire says it's still possible for the country to meet its deficit reduction targets, but only if the next government acts quickly. At a hearing of the National Assembly's Finance Committee, the Maire said his successor should cancel some of the €16.5 billion of credits the outgoing government has set aside. Goldman Sachs Chief Executive David Solomon is warning that business for the bank's trading unit is on track to drop 10% from the prior year. That's led by declines in the fixed income division. The company will also take a $400 million pre-tax hit in its consumer business as it moves away from its credit card tie-up with General Motors.
First, with respect to trading, I would say that with FICC and equities, we had an extremely strong third quarter in 2023. And given this quarter, given what I'd say is a more challenging macro environment, particularly, in the month of August, that business is trending down close to 10%, largely due to FICC.
And Australia's banking regulator has proposed phasing out the use of AT1 bonds, the kind of securities that were wiped out after the Credit Suisse collapse. The Prudential Regulation Authority says the move will support financial system stability at times of crisis. Now we're going to take you live pictures of preparations for the latest SpaceX launch, sending private astronauts into space. We are counting down to that launch. You can see live pictures now. Cape Canaveral, of course, in Florida, and the aims and ambitions of this mission to send 4 private astronauts, including billionaire Jared Isaacman, who paid for much of this mission, on a mission that will attempt the world's first commercial space walk. So Jared Isaacman will be amongst 2 of the astronauts who will attempt that spacewalk. And they will also, the team of 4 astronauts, be carrying out a number of scientific experiments whilst they are in near orbit as well. So we're counting down to the launch, expected in the next few hours, of course. We'll bring you that for you live when it happens. There's been a couple of delays before, but of course they are hoping that the weather conditions will prevail and allow this launch to be successful. Again, including 4 private astronauts, including the billionaire Jared Isaacman. We'll keep across that for you. Live pictures of Cape Canaveral in Florida of that upcoming SpaceX launch. Coming up, former ECB President Mario Draghi calling for as much as €800 billion of new spending by the European Union. We'll discuss his report next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Chinese shares slide, heading for their lowest close in more than a 5-year period as bearish sentiment grips the market. But exports from China unexpectedly jumped to a 2-year high. Apple reveals the latest version of its flagship iPhone, aiming to entice buyers with the promise of AI-powered tools. This as the company awaits an EU ruling on whether it owes a €13 billion tax bill. Plus, Trump versus Harris. The Republican and Democratic presidential contenders prepare to face off for the first time in a live debate. We will set you up on what to expect from the politics of the US. Let's check in on these markets, and politics will be part of the mix, of course, and the inflation data that drops out of the US, of course, on Wednesday, with expectations that the headline CPI number will come down to 2.6%. So in line with that move to lower inflation, that 2% target for the Federal Reserve. European futures, though, are flat, looking for direction after gains of 0.8% yesterday. It was a decent session on Wall Street, but of course the losses in the previous week not yet made up for. FTSE 100 futures pointing lower by 0.4%. The S&P futures down by just a tenth after gains of around 1.2% by the end of the close yesterday. Nasdaq futures pointed to losses of 52 points. The Nasdaq 100 closed up by 1.3% yesterday. Let's flip the board and look cross asset. There's not much movement in treasuries at this point. Again, there's been pricing around the front end. It seems that traders are fading some of the bets on a 50 basis point cut from the Fed on September the 18th. But again, the inflation data could change that. The 10-year at 3.70, the pound at 1.30, Brent 71.71, just down 0.2%, and gold holding above 2,500 per troy ounce, just down 0.1% in the session today. Now, former ECB President Mario Draghi calling on the EU to invest as much as €800 billion extra per year to transform the economy. In his long-awaited report, he also called for a commitment to regularly issue common bonds to make the bloc more competitive. For more, let's bring in Bloomberg's Oliver Crook in Berlin, standing by with the details. Ollie, what is Draghi's diagnosis of what is wrong with Europe?
Yeah, Tom. So listen, this report took more than a year to put together, and he finally delivered it. And I think that it's sort of he puts this in really sort of existential terms, which may sound a bit absurd to people living in Europe today. Obviously, it's such a wealthy continent and it has home to so many large companies. But really, the way that Mario Draghi is talking about this is that in the fullness of time, if Europe does not reform itself, it is basically at risk of being economically relevant, period, right? That may, and we sort of get that sort of a sense a little bit here in Germany as we're watching that sort of slow motion economic slowdown, really brought to home, I think, last week, Tom, by what we heard from Volkswagen. Basically, once the largest car company in the world, now less than 8% of Tesla's market cap. And this is basically what awaits the rest of Europe, according to Mario Draghi. He really sees this as basically the main issue here being the technology gap. And the consequence of that technology gap has been a huge productivity gap that exists between the United States and Europe. He said since 2000, basically per capita incomes have grown twice as fast in the United States as a consequence of this. Europe has been basically unable to hold on to its unicorns. More than a third of them leave once they're founded here in Europe. There is a huge labor shortage that is coming in 2040. More than 2 million people net will be leaving the workforce. And basically the solution to that problem he sees as basically trying to boost productivity. He also points to the fact that in the last 50 years, Tom, there has been no company founded in Europe that has a market cap of more than 100 billion euros, whereas in the United States, all 6 that are over $1 trillion were founded in the last 50 years.
The technology gap is stark, isn't it? What are some of the solutions he's pointing to then, Ollie?
Yeah, Tom, in short, basically it's for a bigger and more unified Europe. And that is something that is going to get a lot of resistance, particularly in this political climate, whether you see it in France or Germany. Already you're seeing sort of a more of an attack to the right, even by the socialist government here in Germany, basically being more Eurosceptical. What he's calling for is more Europe. Basically, he says that the U.S. and China are able to coordinate their trade and their fiscal policies in ways Europe is just unable to do it. He talks about basically with the need for collective spending on defense, procurement, capital markets, and he uses some really interesting concrete examples. There you see already the reaction from the German finance ministry saying that joint debt is off the table. But I think that if immediately having this conversation go to joint debt really does a disservice to the point that Mario Draghi is trying to make. The question, joint debt is just a tool to try to achieve these things. I mean, he talks, for example, about in defense. In Europe, you have 12 different tanks that are manufactured here. In the United States, you have 1. These are the sorts of things that he wants to bring into unison. He also wants to see more mergers. He wants to see more access between Europe European markets, whether it's financial or within telecommunications, getting the grid in order in Europe. All of these things need to happen, basically, says Mario Draghi. Otherwise, it's going to be a slow agony for Europe. The problem with such reports, Tom, that exceed 350 pages is that they can be very easily ignored. It'll be up to the new commission to try to see if Ursula von der Leyen can make these things happen.
OK, Olive Crook on the ground for us in Berlin on the details of that report coming through, of course, from the former head of the ECB, Mario Draghi. Ollie, thank you. On the tech story then, TSMC, just some lines crossing in terms of monthly sales for the month of August, year on year, up 33%, of course, for the company behind the significant foundries based in Taiwan and elsewhere, churning out chips for the likes of Nvidia, of course, and Apple. TSMC, August monthly sales, year on year, up 33%. We'll bring you more details if and when we get them. Now, one area that Mario Draghi is urging Europe to become more competitive in is technology, as Ollie outlined for us, where it clearly lags behind the US and China. His warning comes as commercial uses of generative AI are set to transform a wide range of industries. My next guest watches all of this very closely with an eye to the future. He's Haim Israel, head of the Global Thematic Research team at Bank of America Global Research. Haim, great to have you in the studio. Let's get to that question then, to kick things off, on the gap that exists between Europe, the US and arguably China as well when it comes to technology, but specifically generative AI. How wide is that gap? How much of a challenge is it, do you think?
It's a pleasure to be here, Tom. Yes, there's a gap. This is a revolution. 18 months ago, we all woke up and the world have changed again. And we are big believers that generative AI is going to be as big as the internet, as big as a smartphone. And this is an American technology. The companies that are involved, the infrastructure, the investments, the IP is all American. And EU is behind. And EU have to complete the gap very fast. More than that, what we've seen just in the last 18 months when America have understood that this is a revolution and most of the IP is concentrated in the United States. We saw more silos, we saw more reshoring, more restrictions about technology. And if the EU is not going to complete the gap right now, they're going to be behind. They will definitely enjoy the fruits of AI, but they will have to go to the United States and get access to IP and going to be at the mercy of the United States. Most of it is now being concentrated. Now, we are talking about massive productivity gains. We are talking about everything that's about to change. We're just at the beginning of the beginning. And if the EU is not going to try to start investing today, it's just going to be way too late. Things are accelerating so fast. The development is happening so fast that if the EU is not going to work today, it's just going to be way too late. OK, a pivotal moment then for the EU, it seems, on that particular topic. When it comes to the debate, and there is a heated debate right now within the Gen AI space amongst investors, those with exposure, which is the CapEx story. The CapEx from the hyperscalers, the amount that's being spent, and the gap between the CapEx spend and the ROI, the return on investment. Should investors be concerned? What do you see when you see that gap? I think that the investors should actually be very excited about it because we are in an evolution and we are at the right stage of the evolution. So, as I said, 18 months ago, we all wake up and the world have changed. And I think there's a general understanding that this is about to change everything. But the right investment have to be happening here and now. There's a lot of investment that needs to be done. Companies, it doesn't matter in the industry that they are. It's financial services, healthcare, industrials, chemicals, whatever. They need to start investing today. Implement technologies, map data, silos, regulation. There's so much work that needs to be done, and companies that are not doing it today will not survive in coming years.
And the fact that they're not able to monetize immediately, or at least in the short to the medium term, that shouldn't hold back companies from investing in this space. That's not a concern for you, the lack of monetization.
Contrary, I'm very concerned about companies that are not doing the work right now. It's just going to be too late. Tom, things are happening faster and faster. If the investments are not being done today, in 2 to 3 years, it's just going to be way too late. We've seen that, and history teaches us again and again that if investments are not done, companies are just vaporizing. Tom, if we had this discussion back in 1960, the average life expectancy on a company on the S&P 500 was 62 years. It's down to 17. Companies are vaporizing left and right because there's no long-term and short-term anymore. You need to make the investment today. I'm very excited about companies that are making the investment. I think they're doing the right work. I think that's a vision of management that are willing to sacrifice the short-term to the long-term. While if management will wake up in 2-3 years and start making the investments, it's going to be so way too late for us.
How do you think about some of the constraints on the development of generative AI, whether that's on the energy front, or some have talked to me about a data shortage? People like Demis Hassabis of Google DeepMind have said we're starting to run out of data. We may have to look at synthetic data. How much of a constraint is energy and data on this development?
Resources is a constraint, a massive constraint across the board. We will need more energy. We actually are moving from the world of energy transition to energy addition because the IT sector is consuming so much energy that I think that is not in the numbers yet. Water shortage because all those data centers are requiring a lot of cooling systems, other resources like lithium, like batteries and so on that are all required, copper and so on, and data. Data is so important. Tom, every day we are generating 329 quintillion bytes of data every day. We are not using all of it. There's a lot of other data that we can still tap, but we're reaching to the point that we need quality data. We need real data to train the model. And as a result, there's a new approach, as you said, synthetic data, is trying to create new data that could start training the models. And there's a competition on data. Data is the new oil. Data is the new resources. If you have data, this is probably a big edge going forward. And we are running out of resources in order to start training all those models. The interesting thing that AI eventually also going to be the solution with much better energy consumption, much better new resources, new materials that AI will help us to provide, and eventually even quality of data that all can be run on AI.
Okay, Haim, thank you very much indeed, as ever, framing the developments, the evolution that we're seeing in generative AI and tech more broadly for us in a really smart way. Head of Global Thematic Research at Bank of America, Haim, Israel. Coming up, don't miss our exclusive interview with Apollo Management's Rob Seminara. That's live from the EPEM conference in Paris. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, record returns and now a record glut. But buyout firms say they are now seeing green shoots in the M&A market after deals were crushed by higher interest rates. Opening trade anchor Kriti Gupta is at the EPEM conference in Paris with a key industry player. Kriti.
Tom, thank you so much. We are here, of course. The big conversation has been, what does a deal glut actually look like? Are we in one? Does it get impacted by a different rates regime? And are we starting to see maybe the outperformance of the last couple of years fade a little bit? What does that look like? Well, I'm joined very luckily this morning by Apollo's head of Europe, Robert Seminara, joins me right here in Paris. Robert, a pleasure to have you on the program. Thank you so much for joining us. Look, I'm struck by some comments that your colleague, Scott Kleinman, made over at Super Return. I have to quote it because it's such a juicy one. He says he's here to tell you everything's not going to be okay, to expect lower returns until the pig moves through the python. Has the pig moved through the python, Rob?
First of all, thank you for having me. A pleasure to be here. Look, we're at an interesting inflection point. I do agree with Scott. For many years, obviously, rates were virtually at zero. And that low cost of capital enabled people to pay increasing prices. When rates go the other way, suddenly that price environment is no longer there. And there was a big gap between seller expectations and what buyers were now able to pay given the higher cost of capital. So what happened was there was a dearth of transactions for maybe a year and a half, almost 2 years now. But what we're suddenly seeing is a realization that rates are not going back down to zero. The cost of capital is what it is, and sponsors are needing to ultimately sell these companies. So what we're seeing right now is a convergence between buyer and seller expectations, and you're seeing a pickup in transactions. We've been incredibly active recently, putting out over $2 billion here in Europe alone. And so we're seeing that expectation, and what you're seeing is some very high-quality companies being sold at prices that we think are attractive, and we think that trend will continue.
But does that create some sort of impatience with investors? I mean, we've had this kind of broader conversation about the fact that there's so much money wrapped up right now in that private equity space. Over $3 trillion, I think, is where I read somewhere is the figure. Does that end up meaning hasty returns, that investors want to get their cash faster, get their returns faster? Or does that mean you kind of hold on to it for a little bit and then maybe get a juicier return down the road? What's more likely there?
There's definitely pressure from the LP community to return capital, right? They haven't seen sales for 2 years now. Yeah. So you're getting definitely the pressure to sell. But there's also the realization of if you're selling when you paid too much, you're not going to get the kind of returns that people expect. And so there's that tension that's happening. And the balancing act is the highest quality companies are being sold first. Those are the ones where investors can get good returns, and those are the ones most likely to result in a transaction and not a failed process.
Yeah.
So you're definitely seeing that. The element, though, that's extra to this is that much of this debt that was issued that was incredibly cheap was issued a few years ago now, so it matures in the next 1 to 3 years. So what you're going to see is as those capital structures mature, you can't refinance to that same level. So the sponsor will say either I have to put more equity in, refinance it, and keep that company for 4 or 5 more years, or I'm going to have to sell. So you are seeing some pressure that will come as these capital structures mature.
How do interest rates play into all of this, given that we're staring down the barrel of a global easing cycle that's coming almost as quickly as the global tightening cycle did? There is a thought here that opens the deal spigot and it speeds everything up, and suddenly capital markets just open wide. What gets in the way of that?
Well, first of all, we have to debate how low will rates go and how quickly will they get there. We don't believe rates go back down to zero. We think they go to a more normal environment. And so I do think there will be a tailwind of rates coming down, but there's a limit to how low they will go. The second thing I would add is that while you have rates coming down, it should be a very good time for private equity. I think the vintages that Scott was mentioning in the quote is if you bought companies 4 or 5 years ago, those will be tough returns and it's not going to look great for investors. But I think investors right now will be very happy with the private equity returns they're getting for the next 3 or 4 years, because if you're buying in a high price environment, inherently prices will be lower because the cost of capital is high, but then you're selling in a lower rate environment. You should be selling with a tailwind. And private equity returns going forward, I think, will be very attractive for investors.
Is that a U.S. dynamic, though, or is that a European dynamic?
I think that's a global dynamic. We see opportunities in the U.S., we see opportunities in Europe. If you look at Apollo, we have one global fund, but we usually invest about 20 to 25% here in Europe. We invest, obviously, the remainder, the vast majority in the U.S. Now, we are buying global companies, so it's a little bit of an artificial divide. But if you look at the returns of our European portfolio versus the U.S. portfolio historically, they've been virtually on top of each other. Even though, typically the U.S. economy has been slightly more robust, and we do think the U.S. economy will be more robust than the European economy right now, purchase price can offset that, right? We think we're buying good quality companies. We're really working with those management teams to improve those companies, that we're getting the same returns here in Europe.
So, Rob, we're here in Paris, the beautiful city of Paris, where in just the last week or so, we've seen a lot of developments on the political front. In the last 24 hours, we've seen Mario Draghi issue a very big call for more investment in Europe, echoing a lot of the sentiment that we've had globally and certainly from leaders in Europe. But there is a marked hesitation about doing that. He's calling for $1 billion of investment. Governments in France and Germany and other parts of Europe are saying, we don't have the money to do that. Where does private capital step in?
Yeah, we think this is a golden opportunity for private capital. We've been talking to date right now just about our private equity business, but if you look at our private capital and our credit business, it's $520 billion that we want to invest. And the nature of our capital, it's either in long-term locked-up funds or it's in regulated balance sheets, which are very long-term capital. And that makes us a great partner for corporations that want to invest long-term. We can lend to these companies. We can do hybrid capital. If you look at the Intel deal that we just announced a few months ago, that's an $11 billion investment we made alongside one plant that Intel is investing in Ireland. And so we can be that gap, and we think there's a huge opportunity for investment for private capital.
Does that come, though, at a higher cost, given the risk and given the underperformance of this region?
It comes at an appropriate risk return. What we do is we work with the companies and say, how can we de-risk these investments? What we want to do is provide them competitive capital. We obviously need to think about risk return, though. There are certain situations where corporations can do things in the structuring of the deals to basically de-risk them. In the Intel example, they need these chips basically to fund the digital future that we're looking about. AI does not happen, obviously, with chips. And so we have some real assurance that they're going to need those chips. Those are going to be sold in the market. And if we get comfortable with that risk, you can do it at a very attractive capital price. And so what we're doing is investing large chunks of money, but investing it at returns that make sense for these corporations.
Well, let's stick with that example there. You use that keyword assurance. Do you need government assurance, specifically in Europe here, when we're talking about things like AI? We're talking about that CapEx investment that may not exist in this region to the same extent that it does over in the States. What do you need to see, as the large player that you are, in some of these government conversations that you're having, these backstops? What does that look like?
Depends on the situation, right? Every situation is slightly different. But ultimately, that's where, again, private capital can be very good. What we've done at Apollo is we've married a credit business with a business that historically was a private equity business. Right? We're used to complicated transactions. We're used to working with corporations, doing the diligence, trying to really identify the risk. And so it can come in different things. Clearly, companies like the quality of Intel and others we've invested in. We've invested 3 times with Air France here in Paris. There are certain elements of their businesses that are very reliable, very stable, rock solid parts of their company that are so core that you can get comfortable with the risk on just the corporate. But there are situations where the government wants to enhance the credit because they want lower cost of capital because it's important for their citizens. Right? Ultimately, at the end of the day, these governments want the economies to grow. They want these companies to prosper. It does well for the companies. It does well for the employees. Yeah. It does well for their economies. And so if there are certain tax incentives they provide, if there's certain assurances they provide, that just lowers the cost of capital and helps everyone. So we're happy to work with governments around those type structures. Right. But it's more purely a function of every situation is different and how do we find the right risk return.
All right. Rob Seminara, it's good to see you. Thank you so much for joining us this morning. Tom, he really zeroes in on the exact concept that we're talking about. This is where you're seeing the tension. You have these budget issues on the government level. You're trying to attract more investment. Where does private capital play a role? Apollo seems to have the answers. Tom.
All right, great conversation. Chrissy Gupta on the ground for us in Paris. We're going to continue to bring you great interviews, of course, through the day from the EPEM conference in Paris, so stay tuned for more. Coming up, we're going to give you a look at the Apple proposition and Chinese equity. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, we had some fresh data out of China today suggesting that the export engine of that country is on a better footing, but none of that has done anything to slow the rout in Chinese equities. And this is the longer-term view because we're now closing in on the lowest level since 2021 for the CSI 300, the benchmark Chinese equity index, and the downside from that peak in 2021 of 45%. The concerns, of course, about the health of the consumer, the linkages to the property market and the crisis that continues in terms of real estate of China, and, of course, the geopolitics as well, the tensions building up to the election in the US around November. Let's flip the board and look about the outperformance of other global markets compared to the plight of the CSI 300 and Chinese equities. And there, again, taking you back to 2021 or pre-2021, this is over a 5-year period to 2019, you can see what is happening here in terms of the divisions. Over that period, by the way, the S&P is up about 80%. The CSI 300 in that period is down about 17%. So completely delinking from what's happening in the S&P. And, of course, Japan, Europe and India all performing comprehensively better than Chinese equities over that period of time. You could be set for a fourth, and this is unprecedented, 4th year of declines in Chinese stocks. Plenty more coming up on Bloomberg TV. Going to be speaking exclusively to AstraZeneca's CEO, Pascal Soyot. That's at 9:10 a.m. UK time. The opening trade, though, is up next. This is Bloomberg.